What you're witnessing is the first real sovereign default of 2026, and it happened before Wall Street even opened for business. This is not speculation, not a rumor, and not a simulation. It is a confirmed event. Late on December 31st at 11:47 p.m. local time, port authorities in Shanghai began rejecting silver shipments destined for COMEX-approved vaults in the United States. The default clock did not start. It already struck zero. When New York attempted an emergency lifeline call to Beijing, the response was not silence. It was rejection. China refused. No negotiations, no counteroffer, just no. Earlier, the system had an estimated 48-hour window before reaching a critical deadline. That window collapsed into less than 8 hours when China began enforcing its new strategic metals export restrictions ahead of schedule. Not at midnight on New Year's Day, but immediately. As a result, COMEX will open on January 2nd, facing a physical delivery crisis that paper contracts cannot solve. This marks the event horizon for the silver market. A synthetic pricing system built on leverage and derivatives has collided with the reality that the underlying metal is unavailable, at the posted price or at any price. When physical supply disappears, the math that supports the paper market stops working. While the public was counting down to midnight, system insiders were scrambling to prevent exactly this outcome. Flight data, exchange notices, and first-hand accounts confirm what happened next. At 2:14 p.m. Eastern on December 30th, a Gulfstream jet departed JFK for Hong Kong. The passenger list was concealed. Observers say it carried senior J.P. Morgan Commodities executives, a high-ranking CFTC official, and a representative from the Chicago Fed. That detail matters. This was not about a private metals trade. It was about the core plumbing of the financial system. Silver sits deep inside collateral chains, swap desks, and margin structures. The people on that flight knew the risk, which is why a central banker and commodities traders were attempting an emergency rescue at 30,000 feet. The delegation arrived in Shanghai the morning of December 31st and met privately with officials at the Shanghai Futures Exchange. The U.S. proposal was simple, an emergency purchase of 50 million ounces of silver for immediate export. Payment would be made in U.S. Treasuries via a bilateral currency swap, bypassing SWIFT and framed as a strategic reserve transfer to avoid the upcoming export ban. On paper, it was clever. In reality, it was last-minute panic. After 37 minutes, Chinese officials returned with their answer. No, no delay, no renegotiation, no higher price, just no. The meeting ended immediately. Hours later, Shanghai port authorities began stamping outbound silver containers bound for the U.S. with a red notice. Export clearance denied. This is not speculation. Multiple bullion logistics firms confirm shipments are sealed, trucks are idle, and paperwork now blocks export under active regulatory enforcement. The controls are no longer theoretical. They are live. In plain terms, the U.S. quietly tried to buy its way out of a COMEX delivery failure, and China refused. This stopped being about price. It became about control. China chose to retain its physical metal rather than rescue a paper system built on promises. When mainstream media covers this, it will be softened into trade disputes and regulatory enforcement. What they will not explain is why a Fed official was on that plane, why the CFTC was involved, or why a simple metal purchase required government-level coordination. Asking those questions would expose the truth. The paper silver market is missing most of the metal it claims to represent.